Hello everyone, welcome back you all to my channel. Today's video is going to be super important and super interesting for all those people who want to understand credit risk. What is credit risk? How the model life cycle is working in credit risk? What are the data pillar team is doing? So there are two components obviously. One is the data, second is the model. So I am going to talk each and everything which I have learned throughout my 12 years in banking, in credit risk and multiple portfolio I have been working for. So if you want to learn credit risk and the ins and out, like what are the line of defense, how actually risk weighted assets are working, and what is Basel model, what is IFRS 9 model. So today's video is going to be for you, and today's video I'll make a bit long video because I want to talk about each and every component in one go so that you can go through this video and make notes at every proper moment. So we will talk about Basel guidelines, what are the risk weighted assets, as I said, what is PD, what is LGD, what is EAD, what is estimated loss, what is unexpected loss, how credit risk is different from market risk, what is operational risk, everything we are going to cover in today's video. So let's move forward without wasting your time. Just stay with me till the end of this video and you will have a very good knowledge about credit risk overall as a domain. So let's move on. So guys, let's start our discussion. So as I told you, the topic is going to be model risk. Okay. Now, before model risk, it's very important to understand that why you need model risk. Reason is because so many banks are investing so much of money in paying all the resources like me and you, whoever are working in this particular area. So why bank need all this model risk? See, bank always have that thought in their mind that whenever they are making a portfolio, whether that is home loan or credit card, so there is always a chance that the people they are giving the loan or the credit card, those people can default, right? So this thought obviously is the most important, because if people default in the loan, ultimately bank has to suffer the loss. And from where that money is coming from, that is the money from the people like you and me who are the retail customer. We have savings account in the bank, so the same savings account money bank is lending to the people for loans. Now why this credit risk or market risk, everything came into the picture? If you guys remember, you guys have heard about 2008 crisis in US banking crisis. Okay, so in 2008, let me write from red color. Okay, so in 2008 in USA there was a housing crisis, and the reason was because so many houses were built there and the loans were distributed to the people who were not even able to repay the loan. So basically the biggest example is Lehman Brothers. There are so many movies also, Lehman Brothers, and there was one more bank, name was Bear Stearns. So these two were heavily involved in the house loans in 2008. So they were giving so many loans to the people, and they started distributing loan to the people who were not able to repay the loan. So they were giving loan to the people, and the people credit worthiness. Now what is credit worthiness? I'll tell you. So banks gave loan to the people with less credit worthiness. That means those people were not even eligible for giving the loan, but bank wanted to make so much profit that people will pay the loan. So that's how in the end what happened, that people could not pay the loan and then the market crashed. And Lehman Brothers was even sold. That was the one of the largest bank, like I think it was close to the fourth largest investment bank in United States. Over 100 billion of portfolio, 100 billion US dollar. It's a very big amount. Even Bear Stearns was very big. Now, due to this crisis, the banking sector understood one thing, that we need so many regulations. Banking regulations. What does that mean? That loan or any money which bank is giving as a lending product. What is lending product? Like loans, credit card, whatever, they lend to us. Okay, so bank and government thought that now they need some regulations around bank, and very strict one. Okay, so that's why there were some models which got implemented. So like you might have heard of Basel. So Basel is a committee which is in Switzerland. They made some models. So there was Basel 1, 2 and 3, and 2 and 3 are more popular. So one was, I'll not mention it here because one was not more centric towards great regulations, but 2 and 3 are highly popular. And then there was a model called IFRS 9. These are the regulatory models. What is regulatory? By the regulators, which is a government body. So they give guidelines to the bank. Like in India, if you talk about, so our biggest bank is not SBI, it's RBI, the head of the bank. RBI circulate guidelines to every bank, whether that is a public sector, private sector, SBI, or whether that is PNB, that is HDFC, or that is Axis. Any bank. RBI is the governing body. They make sure that banks are doing everything good. Now this is more about the background. Now let's move that why we need banking regulation. So you guys understood it. Because of that crisis, market felt that there should be some guidelines which can save the money of the retail customer. Now let me tell you what is retail customers. Retail customer, it's a very important term. Now everyone who is an individual and holding an account in a bank is a retail customer, until or unless they are not declaring their account as a business account or a current account. That is again subjective what type of customer you are being. In retail there are so many segments, but in layman language, every individual is a retail customer. Because what are the things we take in bank? Like we have savings account, we have current accounts, then we have credit cards, then we have, let's say, personal loans, then we have, let's say, car loans, then we have, let's say, maybe home loans, or we can call them mortgage, because the bank is giving you loan for a mortgage. Okay, now all these type of customer are known as retail customer. Now to save them, basically save money deposit of all these people, bank made these guidelines that these people, normal people, should not suffer a loss. Otherwise there will be a panic in the situation, right? They will not deposit their money in the bank. So if we get to know that our money is not safe, so today only we'll go back to the bank and we'll withdraw our money, and then bank will be bankrupt, right? That's how economy will not be able to run. So the companies need to guide all these company, I call them bank, a company only, right? So all these company or bank, they need to properly save the money. So now for that, all these models were there, like Basel and IFRS 9, all of them have their own set of rules which you need to follow. Now there are a couple of type of risk which arises during that period of time. If I talk about them, now we'll come to the risk side. So if you think from the risk perspective, so the most common and most covered, like the most focused one, is credit risk. I'll explain you in a while what is that. Then second is operational risk. Operational risk. Third one is market risk. Now risk, so there is a probability if we can lose something, that is known as risk. Now what is credit risk? Credit, there is a risk if perhaps the customer default. Let's say I am a customer. Okay, let me go a bit more down. So let's say I am a customer of the bank. Okay, my name is, let's say, Rajat is a customer. Now Rajat is having a credit card. What is a credit card? In credit card, bank is giving me a limit. Okay, bank is giving me a limit that you can spend up to, let's say, 2 lakh rupees. What is that? I borrowed this 2 lakh from bank, then before my cycle date I need to pay this. Credit card is giving me debt, I need to repay. Let's say if I fail to repay this, that risk is known as credit risk. Similarly, if I have a loan, let's say home loan, they gave me a debt, but again, let's say for the home loan, I have a home. Now in this situation, I have a home. Now if I don't pay them, if I default, I'm not able to pay. That is known as default. So what bank can do? They can sell this home and they can get the money back. So they can recover the loan by selling the property without my consent because I take a loan. Okay. Now in this situation, credit risk is the most demanding portfolio in the market, and credit risk has most number of job in India. And the focus will be credit risk only because I have worked on the credit risk area heavily from last 12 years. Now let me give you a brief about operational and market risk just for your understanding. Now what is operational risk? If bank is having any risk of, or they are having any loss due to any operational reason. Operational reason, for example, wrong documentation, or if they pay somebody by mistake because of any system issue, any legal issue, all those type of risk are known as operational risk. Now, what is market risk? The risk which are there because of the market. Let's say share market suddenly crash. Bank is investing in a company, let's say Infosys. The bank is giving so much loan to Infosys, and then loan need to be paid by Infosys, obviously, for a new plant. Okay, they took a loan for building a new plant somewhere. Now, suddenly market crash, IT sector crash in US. So the price value of Infosys will go down. So there is a risk involved that because of the market, the company will not be able to pay the money. So now in this case, this type of case, what bank usually do? They keep interest rate high because they know the market will drop and interest rate higher will give them a lesser loss. Okay. So this is a brief, but our focus is this. What is credit risk? Okay. Now let's move forward and let's talk about credit risk. What is credit risk and how you guys can get into any of the bank like Citi, HSBC, Wells, JP Morgan, Standard Charter, Commonwealth Bank of Australia, so and so. There are a number of others. Okay. Now, if we talk about credit risk, so it's made of two things which I already explained you. One is the credit, which is a debt. Then there is a risk factor. Okay. So in this only two parties are there, if you understand. One is the lender. Lender is who? The bank. Then second person is us, who is a borrower. So in banking term, we call it lender and borrower. So bank is the lender and Rajat is the borrower. Now they are giving me money. Let's say they are giving me home loan and the bank is, let's say, HDFC Bank. They are giving me home loan and I will be paying them the loan back in the form of EMI. So there is a risk factor, that probability that I will default is the risk for them. That is known as credit risk. Now, if you talk about, let's say, credit card, okay, if I give the example, so credit card, I already gave you one example, home loan, I already gave you example. Now, one definition I want to give, the likelihood that Rajat want payback is credit risk. In short, I can say it CR. Okay. Now, one more important factor, risk based pricing. Just remember this term. What is risk based pricing? Whenever bank is giving loan to Rajat, they obviously checked Rajat background. What is the salary of Rajat in past? Let's say how many times he defaulted, what is the credit score of Rajat, how many property he owns, do Rajat have a savings account with us, let's say, in which account he is holding very good amount. So all those things they check. So let's say if I am a very risky customer and they know that Rajat is a risky customer, so they will give me a loan on a very high interest rate. So basically you can say risk and interest, they increase together. The more the higher the risk is, the more the interest rate they will take from me. So Why they do that? Because the more interest I will pay to them, so they will be able to recover more money from me easily. That's the target here. Okay. And that is the ultimate goal which they have, that to safeguard the money within the bank. Now, this house which I purchased, let's say from this home loan, this is also known as mortgage backed securities. Let me write that. This is a very commonly used term, mortgage backed security. What is that? Any home which you are building by taking the loan from the bank is known as mortgage backed security. What is mortgage? Your house is a mortgage, okay? Because if you don't pay the amount, they can sell your house and they can recover their money. So it's pretty simple, okay? Now let's move on to some other factors. So whatever the loss the bank will get if I'm not paying the money is known as expected loss. So loss is of two types, expected and unexpected. Unexpected loss can be because of the market crash or some other external reason, but this is expected loss. In this scenario, there would be expected loss. Now, what is expected loss? It's based on two type of factor. In this video, I'm going to cover on these two aspects only. This expected loss is further divided into two things. Like obviously, loss is based on some factor. So bank will have those things in their mind, that what are the things we need to consider. So the factors are two, as I told you. So number one is borrower based, like how much is the salary borrower have, what is the background he's coming from, how much experience he hold, which geography he's working. Let's say he's working in US and all, whether he's working in any country which is much more risky, let's say Afghanistan and all. Okay, everything does matter. Now this is borrower specific factor. And then the second type of factor which affect the expected loss is economy specific factor, like how the economy is doing, what is the need of the economy at that moment. So those factor also affect it, because obviously all the economic factor will drive the growth of the individual in that particular country. So that is very important. Now to calculate the expected loss by the any product in bank, let's say the home loan we were talking about, what are the things need to be calculated? If you ask me that, Rajat, how to calculate the expected loss? So there is a simple formula, ECL equal to, this is expected credit loss, or we call it EL, expected loss, or ECL, same thing. Okay, expected loss, expected credit loss. Now this is a output of PD product, LGD product, EAD. Now obviously the first question comes, what are they? PD is probability of default. That what are the chances that one person will default? When bank is giving loan, bank always calculate this, that when we are distributing the loan to this customer for home or for credit loan also, there are so many type of loans. Okay, let's say for starting a new company you are taking a loan, small loan you are taking as a personal loan, any type of loan, they always check the probability that the customer will default. That is PD. Now LGD you can say the full form is loss given default. So first let me write that, loss given default. So when the default will happen, how much the loss company will suffer, that is known as LGD, loss given by the default. Now we have the third element, which is EAD. What is EAD? Exposure at default. What is the total amount at exposure on a particular time? That is known as EAD. Obviously, when the loan was given, the EAD was much higher. After 6 months, it bit low. After 1 year, it's more low. Obviously, because you are paying EMI. The more EMI you will pay, the EAD and LGD will decrease. Okay. And PD is probability of default. So that is always continuously in the radar of bank. Whenever bank is giving you the loan, don't think they are just doing some paperwork. They are calculating everything, that what is the expected credit loss this person Rajat can give us as a customer. So they calculate all these portfolios and then they build the model on them. Now, you might have heard of PD models. So we have three type of model. Okay. In credit risk, under expected loss calculation, PD, LGD model and EAD model. Now, there is a huge mathematics on the back end. Okay. But let me tell you in some layman language, because if we go on the mathematics, this will be very heavy session for all of you, many of you. Let me talk about some real life example to calculate all these pointer, how you calculate them. Now, let's say if I want to buy a house and let's say the house price is 5 lakh rupees. Now, bank told me that maximum loan you can get is 80%. 80% loan means what? 4 lakh. This is something which bank will give me. Now, my own pocket need to pay 1 lakh. You guys understand that? Many of you might have taken the loan, right? So that is known as customer commitment, or we can, for now I'll just call it customer will pay 1 lakh from his pocket and we can sponsor as a bank 80%. That is 4 lakh. Now, currently exposure at default when the loan will start is 4 lakh and your EAD and LGD will also be 4 lakh. But that is not the case. That cannot happen. On the day when the person will not default, right? There would be some particular period. Let's say the customer is paying for 1 month, 2 months, 3 months and years. Sometime it happens because of unwanted situation like COVID. People were not able to pay the EMI because there was a huge job loss in the market. So we need to consider all those factors also. Now, let's say if I want to sell this house, okay? So why I want to sell this house as a bank? Let's say customer defaulted. I take a situation, the customer defaulted. Now, what is the meaning of default? That is again is question. Customer will not default on day one. I told you guys. So now this 4 lakh, if I distribute, let's say the customer paid 40,000 out of 4 lakh. The pending amount is 3,60,000. Now this 3,60,000 is your exposure at default and loss given by default for this particular period when he paid these 40,000 rupees. But at the same time, now bank want to sell this house because they think that this customer will not be paying this 3,60,000. So bank want to sell it for the maximum value which bank is getting, let's say 3,42,000. So this 18,000 is going in loss. So this is EAD. Now, what is exposure at default is 18,000. Why 18,000? Because this is a price which bank is getting if bank want to sell the house. So they gave 4 lakh, out of 4 lakh, the customer paid this much, and then the rest of the amount the bank is getting 3,42,000, and then 18,000 is going as a loss. Now, this is the EAD, exposure at default, 18,000. So for this, the EAD will be 18,000. Now LGD, loss given by default, will be 18,000 divided by what? This total value, 3,60,000. That is loss given by default. So out of 3,60,000, how much the loss is happening? That is known as LGD. Now, you will obviously ask how we calculate PD. So bank already calculated this, that there is a type of customer. So let's say a salaried customer. So bank will put all the salaried customer depending on the range of the salary. Let's say there are customer or the employees of some company, they have a salary bracket of 50,000. So all of them will be put together. Now, in that case, bank noticed earlier that one person out of every 4 is defaulting. So that means there is 25% chances of PD. So that's how bank calculate the PD, 25%. So we have PD, EAD, LGD. Now you can calculate the ECL here. So you can multiply 25%, 18,000, multiply by the value which this will give, 18,000 divided by 3,60,000. So that is your estimated loss. So that's how the ECL is calculated. I hope this is making sense to you as of now. If you have any questions, so please comment in the comment section. Now let's move forward a bit. Now let's talk about some of the model things. Let's say talk about Basel 2 Accord. That's the name of this model. Now Basel 2, when they came into the picture, so Basel was saying that there is a 3 pillar. Number 1 pillar is minimum capital requirement. That, what does that mean? That every bank should have a minimum capital. What is that minimum capital? We will tell you that you need to maintain, let's say you have total deposit of 100 rupees. So every time you should have minimum 8 rupees in your pocket. If anybody comes to you, you should be able to give those 8 rupees, distribute in the people. So that is the minimum capital requirement. So as I said, this accord had 3 pillars. Number 1 is minimum capital requirement. Then you have a supervisory review. Like you will have a regulator for you and everything will be under the regulator supervisory, and you need to make sure that you submit that review to the federal government, or let's say in India to RBI. Then you should follow the market discipline. That if in market there is a need of the loan, you need to study the market and according to that only you need to distribute the loan. Now the biggest and most important pillar here is this one, which is minimum capital requirement, because this is driven by many approaches. So how you calculate that? Bank obviously asks them. So we need to check on the approaches also. Bank asks this question that for minimum capital requirement, what should be the approach? So there are a couple of approaches which actually the federal body suggested. Obviously we will cover about credit risk only. So that is CR. So for credit risk, what type of approach you can use? So number 1 is your, let me make a diagram here. Number 1 is your standard approach. What is standard approach? In standard approach, all the PD, LGD, EAD are calculated with the help of external vendors. Like we have so many companies like FICO is there, S&P Global is there. Then we have Fitch ratings. So many rating companies are there in US which are very reliable. And like in India we have CIBIL score. So similarly like that. Now this was a defined way. So in this, the bank need to give so much good capital. Let's say for house lending, they need to keep the 75% as a deposit to safeguard the money from the people. So which is a high amount. So that's why bank are not much interested in applying this approach, the standard approach. So bank gave another option, that is IRB, or we call it internal rating base. Internal, oops, this just let me come, yeah. So internal rating based approach. Now this internal rating based approach is further divided into 2 types. What is, obviously number 1 is what is IRB approach. So IRB approach, bank has the flexibility that they can calculate PD, LGD, EAD, everything internally. Like unlike the standardized approach where the external person will tell them. Now here this IRB is divided into two types, F IRB, AIRB. F stands for foundation. Okay, this is pretty much understood, like the foundation. I'll tell you the difference going forward. Now A stands for advance. So foundation internal rating based approach and advanced internal rating based approach. So both of them have a different set. Now here everything was given by external. Here couple of things are given by external. I'll tell you in detail now. I'll make a table here. So couple of things are given by external vendor, and in AIRB, this is the most popular one bank using. Why? Because in this you have the flexibility to calculate everything by your own self as a bank internally, and then you can make sure that that enough capital you have. So the advantage which bank is getting here, they are not stick to this 75%. They can stick to, let's say, 25% also based on their risk taking ability. So that's how this AIRB approach is very much popular. And in many banks, people are working on AIRB models where they are building their own model. They are calculating their own PD, LGD, EAD. Now, why the regulators are allowing this? Because they also trust the approach and there is a regular audit. So all these banks go for regular audit to the big four, especially like Deloitte, PwC, EY and KPMG. So these four are big four audit company. So bank go to big four. Big four are doing all this audit. Now this audit will give them the data, clear visibility. They will also report it to regulator, who is a government body. They also report it to regulator, so that everything is in sync and your money is safe. Now, if we talk more in detail about these approaches, how the approach are there. Let's say there are three things which I told you: PD, LGD and EAD. Then what are the approaches? We have standardized approach, I have FIRB, then I have AIRB. If I make a table here, this will clear all your doubts. This is a table which covers all the aspects. Now, in this standard approach, everything is external. All three factors are given by external vendor. Now, in FIRB, this is internally calculated probability of default, and these are external, LGD and EAD. Who provide all these value? I'll write the name also. Let's say FICO. They give the score. FICO is the most popular in US. FICO, S&P Global, and there are so many others. Okay, then there is a company called Paynets. So many company, but FICO is the gold standard, I would say. How FICO give the score? They give you a score from, let's say, 300 to 850. 300 being the lowest score and 800 being the highest score, that the person who's having this much of score of 800, there is a very less chances that that person will default. Okay. So now in FIRB, only PD is internal. In AIRB, everything is calculated internally. So in this, bank have a very good advantage if they calculate it correctly, and they are obviously doing it correctly because everything is being reported and regulated and audited. So bank have the max capital with them to lend. Lend means to give other people. Why? Because you are calculating ECL with the help of these three factor here, and everything you are doing internally, so nobody knows your data better than you. And in the other approaches, obviously there were external parties were there involved, so you need to be very careful, and according to them you need to do this approach. Now this is the overall how the risk is being calculated. If I take you more in detail, today I'm going to share everything with you guys, whatever I have learned. Like I'll try to maximum. If I go like totally in detail, that will be like so many hours of video. So let's not do that. But I'll be very pointed here. Now, one more very important concepts come here. Obviously, I mentioned about enough capital. That is pillar number 1. So there is a term called capital adequacy. What does that mean? Enough capital the bank should have. Then from this capital adequacy, there is a ratio which bank calculate, that is known as capital adequacy ratio. In short, we can say CAR. So in bank, you will hear so many times that this team is working on CAR model, CAR. So this is nothing but sufficient capital calculation. This is the core concept. So you are basically doing a calculation so that there is sufficient capital in the bank. That's how you do that. And now how you calculate capital adequacy ratio. In bank, there are two type of thing. One is the asset, then their liability. Asset is like what are the asset they have, what are the things which will give them money, what are the liability, like how many things they need to pay, and both of these are part of balance sheet. Balance sheet talks about all the assets and then liability. So liability is not itself like what are the things bank need to pay. Let me give you one example also, like loans, which bank has given, and credit cards. So they are giving interest to the bank. They are actually earning for the bank. So they are like assets. Other than that, you have physical assets. Like SBI will have so many branches. They will have buildings. They have assets. They are invested in share markets and mutual fund, this, that, so many things they are doing that. Now what are the liability? Savings account, current account, FD. All these are liability. Other than that, capital requirement, that is a liability, guys. Now this is a tricky one. Capital is again a part of liability, because bank need to maintain sufficient capital that they should be able to run the bank and give the money to all the retail people when they are going in the branches. So there should be no crunch of money. Money crunch should not be there. And to calculate CAR, there is one more formula. The formula says capital divided by RWA. Now I'll tell you about RWA. It should be greater than or equal to 8%. That's how the Basel 2 says. This is according to Basel 2, guys. Basel 2 model. Now, what is RWA? Obviously, that is the next question comes to our mind, that capital we understood, but what is RWA? RWA stands for risk weighted assets. What are risk weighted assets? So those assets where we have a risk, or the bank is having a risk that these assets can be riskier, like I was talking about the loan. Asset is a different thing, but risk weighted assets, obviously, because they can give the loan a default. So it's not necessary that all the 100 people who are taking the loan, they will pay back. Obviously there is a chance of, let's say, 5%. So if 5 people are not giving the loan back, but these 95 who are good, they are able to contribute everything to the bank, so that bank can manage the enough liquidity in their account. What is liquidity? Liquidity means like they are having enough money in their pocket so that they can run all the function, and if people are going to ATM and they are coming to branches, so they are having everything sorted now. Okay, so guys, this was all about credit risk. Okay, and there are so many terms which I have been using here. Now, other than credit risk, let me talk about a model life cycle. What is model? To build all this credit risk secure, there are models where companies are working. Now, this is a different topic. This is altogether a big domain. Now, let me talk about risk management. As of now, we have covered couple of so important things, and I'm not sure like all this data is there on YouTube or not, because all this thing I am like trying to share from my personal experience, from my notes, whatever I have made. Now, in risk management, to track this, there are line of defense. To track the risk, so there are 3 line of defense, that on which level you will catch that there are chances that default will happen. So first line, then your second line of defense, then third line of defense. So first line of defense is model developers, who are the programmer, and model owner, the people who own those products from bank side. Let's say any person named Jimmy Choo, so they are the credit card owner. Okay, so these are also designation in banks, so they are like credit card owner. So they will tell a programmer in India that you need to build my model. So this is the first line of defense. Then the second line of defense talks about model validation and model monitoring. The people who are validating and monitoring the model once they get the model from the model development team. So this is your second line of defense. Now, third line of defense is your external vendors, like Big Four, when they perform audit, like EY, Deloitte, and so on. So that is third line of defense basically. First line of defense clear, model developers, model owner. Second line of defense, model validation team, model monitoring team. Third line of defense is external. So bank always maintain these 3 line of defense to mitigate or to avoid the risk. Okay. Now let me talk about model word. What is model? We have been hearing so much what is model, credit risk model, market risk model. Model is nothing, it's a code which follow, and this code is based on guidelines by federal government, I mean to say. In US, let's say in India, it's RBI. So this code will follow all the guidelines given by the federal government or the RBI. That is known as a model, and this model can be any type of model. It can be like logistic regression, linear regression, depending on the situation, but most of the time the models which are used heavily are logistic regression model. I'll not go in detail because that is mathematics, but today's video is more to get you the banking knowledge. Okay, so they will be building a code. Model is nothing, basically a code full of guidelines, full of multipliers, coefficient, everything will be there in this code, and on the basis of this code you will calculate either PD, you will calculate LGD or EAD, and in last you will calculate estimated credit loss. So ultimately the objective is to calculate the ECL only. Now some teams in company, they work on PD, some work on LGD, some EAD, some work just ECL. So all these people who are building this, they are model developers. These people are building all these codes from scratch. Model validation, they have their own codes. They are validating all these codes which are built by them. And the external audit is validating all the results, that whether the companies are giving correct results or not. That's why this is again very important. That's why you might be hearing that in Big Four that the work culture is very bad, and EY and Deloitte, the work culture, this, that, so many things, because they have been working heavily on the heavy lifting. They are doing the heavy lifting for the bank for making it secure and much more safe. Now, let me talk about the last topic for the day. That is model life cycle. Now this model which I explained it to you, obviously this model have a life cycle. because every few years the market changes, so model also need to be changed. You cannot make one model and keep it for always, for whole lifetime, right? So now the first step is initialize your model, or we can also call it identify, that which model we would be building. So this will be done with the help of model owner. You will check with them depending on the requirement, you will suggest a model. Second step or stage will be development. That will be done by the model developer team. So they are playing the most heavy role here, one of the very heavy. And the model development, they are using so many programming language. Let's say they are using Python and SAS in banking. Especially in banking, Python and SAS are heavily used. Now after development, the next is validation. So validation means obviously like validating the code with the right set of approach, whether the development team have correctly done it or not. Then comes the implementation team. So this is more like a testing team as a double layer of security, that validation has gone correctly, and testing team is called a implementation team here. Then you have a maintenance team. Once everything is validated, so you will see that the model maintenance will move to a different team, and that team we called monitoring. So they monitor the model depending on different characteristics. Like I'll give you one example here, small, like stress testing. Some of them are performing stress testing, some of them are performing credit benchmark, and so many other metrics they are checking. Okay, so this is the sixth step, and the last step is, once the life cycle of model is completed, and if there is a change in the rules, or let's say the model owner say that the rules have been identified by the governing body, by the regulator, so that is the final step, that is known as decommission. So in the last model is decommission. Now this is the model life cycle. Okay, and one more term, all these models are kept in a place, codes in a safe area, that is known as model inventory. All the models are stored in model inventory, where you have the list of the model on shared drive, and you keep on discussing with the model development also access this, then model monitoring team also access this, model validation also access this, and model owner also. So all these four teams are connected with each other on this model inventory. So this is the representation of the whole model life cycle. Now this would be the end of this video, but I would actually encourage you all to go through this slide. What I'll do, I'll post this slide on my GitHub account, and you guys will be able to download it from there. So all this concept which I have explained today, I don't want it to go unnoticed. So I want all of you to download it, and you can open it at your own level. This will be actually helpful for all of you, and I have tried to precise so many things. And I hope if you like this content, so please subscribe to my channel. Please share this with your banking friends who want to work in credit risk or analytics going forward. And I will be keep on coming with more amazing video for all of you. On that note, I will take you, I'll take the leave from all of you. If you like my effort, please subscribe. I will again say that, and all the best for your banking journey. Thank you so much, guys.